Oil prices experienced a notable rise on Friday, fueled by a disruptive drone attack that halted operations at Russia's largest oil port in the West. Yet, despite this initial surge, the gains were restrained by lingering concerns over the strength of U.S. demand. This tug-of-war between supply shocks and demand doubts reveals just how precarious the current oil market really is, and why investors and traders remain cautious. To put the numbers into perspective, Brent crude closed at $66.99 per barrel, marking an increase of 62 cents or 0.93%, while U.S. West Texas Intermediate WTI crude finished at $62.69, rising 32 cents or 0.51%. These modest gains reflect the market's mixed signals. The day's price movements were initially triggered by a reported Ukrainian drone strike that targeted Primorsk, the key northwestern Russian port that handles a significant volume of oil exports. According to officials from Ukraine's security service SBU, this attack forced an overnight suspension of oil loading activities. Such incidents are particularly impactful because they threaten to reduce Russian crude and refined product exports at a time when global supply chains are already tightly balanced. UBS analyst Giovanni Starnovo emphasized that these strikes on Russian energy infrastructure could exert downward pressure on Russian oil shipments, which in turn affects global supply dynamics. However, as trading progressed, optimism from the supply disruption began to fade. Market participants shifted their focus back to the disheartening economic data emerging from the United States, a crucial consumer of oil worldwide. Earlier this week, the U.S. Labor Department revised the previous estimate of job creation downward by 911,000 fewer jobs than initially reported for the 12 months leading up to March. The disappointing labor figures add to concerns about a possible slowdown in economic activity, which typically dampens fuel demand. To complicate matters further, the U.S. also released inflation data showing the Consumer Price Index climbed by 0.4% in August, the largest monthly increase since January. This followed a more moderate 0.2% rise in July. Higher inflation can lead to tighter monetary policies or reduced consumer spending power, both of which could negatively impact oil demand. John Kilduff, a partner at Again Capital, noted that the economic data is not supportive of a rally, describing the overall trend in oil prices as bearish. Another layer of uncertainty involves potential geopolitical measures. The market remains alert to possible new tariffs or sanctions from the U.S. government, aimed at curbing Russian crude imports by major buyers like India and China. If implemented, such policies could significantly reduce Russian oil exports, removing additional barrels from the international market and reshaping global trading patterns. Kilduff commented, "If tariffs adversely affect exports to India and China, we could see a tightening of Russian supply on the market." It's worth noting that both Brent and WTI prices dropped sharply the previous day, by 1.7% and 2% respectively, underscoring the recent volatility. Adding perspective, the International Energy Agency (IEA) projected that global oil supply will grow more swiftly than anticipated this year. This uptick is largely driven by planned production increases from the OPEC Plus alliance, which includes major producers such as OPEC members and Russia. This outlook suggests a growing surplus that could further pressure prices downward. Interestingly, OPEC released its own report later the same day, maintaining its robust forecast for oil demand growth over the remainder of this year and into the next. The organization cited steady global economic expansion as a supporting factor, highlighting a clear divergence in outlooks between OPEC and the IEA. On the supply front, a significant development is coming out of India, which is the largest buyer of Russian seaborne oil. The Adani Group, the country's biggest private port operator, has banned tankers carrying Russian crude that are under Western sanctions from entering all its ports. This move could restrict the flow of Russian oil to India and potentially tighten supply further. The ban stems from pressure linked to sanctions imposed by the US, EU, and the UK. To sum up, the oil market finds itself at a complex crossroads. On one side, geopolitical tensions and supply disruptions lend upward momentum to prices. On the other, weak U.S. economic data and a mixed global demand outlook put downward pressure. This conflicting environment makes predicting short-term trends especially challenging. But here's the part most people miss. How will the evolving diplomatic stance on Russian sanctions play out? Will stricter enforcement push Russia out of key markets entirely, or will new workarounds emerge? And with inflationary pressures mounting, how might central banks' responses influence future demand? These questions are critical and could lead to sharp market swings. What's your take? Do you think the recent drone attacks will have a lasting impact on Russian oil exports, or are these just temporary blips? And how confident are you that U.S. demand fears will continue to suppress prices? Share your thoughts and let's dive into this debate together.